Hey guys, welcome to our new lesson on understanding the differences between RRSP and TFSA accounts and how I use this illustration to help Canadians understand what to do with their money. This is essential information for Canadians planning their financial future and retirement savings. We'll start by discussing the concept of pre-tax versus after-tax dollars. This will help us understand where each type of account can fit into your saving strategy. The RRSP, or Registered Retirement Savings Plan, allows you to invest using pre-tax dollars. This means your contributions are tax deductible, providing immediate tax relief. However, you'll pay taxes when you withdraw the money, typically in retirement. In contrast, the TFSA, or Tax-Free Savings Account, is funded with after-tax dollars. Your investments grow tax-free and you won't pay any tax when you withdraw the funds. We'll explore how your money flows in and out of each account and dive into the unique tax advantages and growth benefits. Each account offers valuable tools for growing your savings, but understanding their differences can maximize your financial potential. Stay tuned to this lesson as we break down these accounts and guide you towards making more informed financial and savings decisions. Let's jump in. All right, guys, welcome to the lesson on the RRSP as opposed to the TFSA. Now, this is an illustration I use all the time with clients just to help clarify the rules and the ins and outs of each account type. Once you understand each account type, how they work, etc., it's a lot easier to plug them and understand where they fit in your retirement accumulation strategy, right? So that's another lesson that we'll do. But for today, we'll focus on the RRSP, the TFSA, and what kind of framework can we position them in order to understand them better in our quest for accumulation. Okay, so first things first, there are two types of money that exist when it comes to personal finance. There is pre-tax money, money that has yet to be taxed, and then there's after-tax money, money that has already been taxed and is yours to spend however you wish. All right? So within those two zones, there are pretty much 4 places that your money can live and be at any given time, okay? There's exceptions to this, but let's keep things simple for today. So first one would be your revenue, your income source. So that could be your own business or your employer, think of your paycheck, etc., right? So your income sources, whether it's your business or your salary, is hasn't been taxed yet. But once it does land in your bank account, which is the second place your money can be, you've already paid the tax, right? Or you have taxes owing on that money that is yours to spend free and clear. So money that's in your personal bank account is after-tax dollars. Money that is still hasn't been taxed yet, whether in your business or employer, is pre-tax money. Now, when it comes to the RRSP and TFSA, which is 3 and 4 on this quadrant, think of the RRSP as on the same side of the tax fence. So think of this bottom line here as like a filter or a fence that you have to go over or surmount, and that impacts how much tax you get back or pay. So when you have, for example, a group retirement plan or a pension plan, and that gets taken straight off of your paycheck and your employer contributes directly, that money stays pre-tax, never gets taxed, and goes into a pension and RRSP, and that money grows tax deferred. And then eventually when you do take it out in form of pension or withdrawals of an RRSP, then because you're crossing the tax line, you have to pay tax on it, right? But if you take your own funds, your after-tax money from your bank account, and put it into an RRSP, which a lot of people do, you cross the tax line on the other direction. So you get a tax deduction. So whatever tax that you've paid on the salary, and then the amount you put it in your RRSP, let's say it's $10,000, well, essentially, you're going to get a deduction of your salary for that year of $10,000. So you're going to get taxed on $10,000 less. All right. Then that $10,000 grows to $15,000, $20,000. And if you take out the 15 or 20, you get taxed on the whole thing, not only your contribution, but the growth as well. All right. Now, TFSA, if you take your own money and you put it in a TFSA is after tax. Okay. So essentially you put 10K in your TFSA, it grows to 10, 15, 20. You can take out the money from your TFSA tax-free. So the 20K or whatever that it's grown to, your 10K has grown to, you can take it out tax-free. So in and out, inconsequential here. The in pre-tax is inconsequential. A question I get asked a lot is, if I take my RRSPs out and put it in a TFSA, do I still have to pay tax? Yes, you're crossing the line. You're going to pay tax when you cross it over. But an interesting strategy that I do with clients is sometimes you can accumulate and focus on the TFSA first, and before the RRSP deadline or for tax reasons, you can roll over part of your TFSA or all of your TFSA if you wanted to, not recommended, but you could, and then put that into an RRSP as lump sum deposits, and then get the tax benefit from it. So you can contribute to the TFSA, have the flexibility of the ins and outs without tax consequences, and still benefit from the tax savings another time. All right? So these are essentially the parameters of the RRSPs and the TFSAs. There are the kind of the constraints and the rules and the flows of each. What I do in a future lesson or a different framework, if you will, in my accumulation framework, is kind of use these rules and paint a picture of how these accounts could and should probably be used in accumulation for retirement, as well as decumulation. All right, so stay tuned for further lessons on how I illustrate those. So hopefully this was helpful. Till next time, cheers.